Well. Ladies and gentlemen, welcome to tonight's FOMC Live. I mean, if you just tuned in and you are new, welcome. My name is Tino. You've just jumped into the Traders Reality channel where we are going to host the good old FOMC. What's it going to be, man? Bitcoin. I don't know what that thing's doing. Well, we know what it's doing. I said we need it to drop. It must drop before this meeting, ladies and gentlemen. So what's happening across the board? Well, it's the most anticipated time in the US, especially for the financial world. And here's something crazy. I heard that in a local school near me, they were actually talking about the US and the interest rates and that there was this big thing happening today, and it's called the FOMC. It's even happening in the UK, man. Everyone's talking about it. But have you seen what Donald Trump's been getting up to? Royal family in UK is sure laying out the red carpet for him. I mean, come on. It's the first time in history that anyone has been given that treatment in the UK. But Trump, come on, man. You're either with the US or you're against them. That's the truth, you know? So, what's the plan tonight? Well, in the next 20 minutes, ladies and gents, we're going to be tuning into the FOMC statement. This is going to give us the projections. This is going to tell us exactly what the Fed thinks, okay? Now, we're looking for either a hawkish sentiment for the guys that want to short the dear life out of Bitcoin, or we're looking for a dovish sentiment for everyone that wants to buy Bitcoin as it's rising to the all-time highs. Doesn't make sense, does it? So, once that comes into play, that will then give us 30 minutes of free time to go through what's going on in the marketplace, break down a few logics, maybe take a few questions, maybe. It all depends what you guys throw at me. No bold jokes. I used to have hair, now I don't. But then at 7:30, we'll be going straight into the press conference. And it's going to, you know what? I've watched a lot of press conferences before, okay? But this one, I'm going to be in my A game and in my zone. I'm going to pick every little thing that Powell is going to be saying. All right, because that's exactly what the street is doing, to work out exactly what he's trying to say about the path of interest rates. We are starting the easing cycle. That means money's going to be accessible. But has that really stopped the United States? No, it hasn't. US deficit is at all-time highs, $37 trillion plus and growing. Spending more than they should be, than they earned. That's the crazy thing. They're spending more than what they're earning. So that's got a lot of investors concerned. So what we're going to do is just quickly get into the live stream. I'm going to break down exactly what's going on just before the minutes itself. We'll be revealing what the minutes does have to say for it, and then we'll just continue from that point. Okay? Cool. Mad love and respect to everyone passing through. El Captain Bitcoin Bandidos, what's good? Hello, good afternoon, welcome. Let's get with the program, ladies and gentlemen. Here we go. So, Wall Street stays on hold. The markets themselves are kind of stalling. I mean, NASDAQ took a little bit of a tumble to the downside, and it's doing really well to close this gap. That is great news. They've closed the gap beforehand, all right? And we've got a little bit more of a gap, but remember, NASDAQ is so extended to the upside. $14 trillion of capital is in this rally since the April 17th story when it came to the tariff announcements, okay? This is $14 trillion across the S&P and the NASDAQ. Now, with that being said, let's just quickly go and break down what's going on in the marketplace. So it says here that the most anticipated Federal Reserve meeting is happening today and traders are looking for the path of interest rates. So let's just understand where we are. As it stands right now, there are people betting for 93.8% that we're going to get a rate cut, but the market has already priced in the logic of a rate cut, okay? So we know we're getting 25 basis points. So your rates right now are going to drop. Cool. But what investors are really looking for, and you know, I might be regurgitating myself from earlier on, but guys, this is money. We need to understand what it's doing and keep it going in our minds all the time because we've got to pay attention to this. You think trading is just simply about pressing a button? Well, yeah, primarily it is about pressing a button, but you've got to take into consideration what the big boys are doing with Forex. If they're going to get their money in Forex, buy euros or buy dollars, where are they going to then put that liquidity? Why should I now buy dollars given that the euro is so appreciated? Is that something not that you want to pay attention to, or are you just going to pay attention to trend lines and Fibonacci's? No, there's so much more to it, and we are in a macro-driven environment. So when there's a bull run, okay, let me bring it to you like this. If you go and look at all the top traders from back in the day. They were always killing it. They were deemed as the greatest of the greatest traders. But then some people come out and say, yeah, but look at the bull markets that they were involved in. Even if they just picked a stock at random, it still would have made them money. But we're living in such volatile times where so many things can happen, okay? But that's why we are in a macro-driven environment and not so much a technical one, but technical analysis does help us understand where investors' logic is at. Now, as it stands, you see that NASDAQ has already got this story of interest rates being priced in. Historically, when the market gets a Fed pivot, it actually corrects. Now, not to scare you again, but if we go back to the 18th of December in 2024, yeah, that's when the market made a very significant move to the upside. Where is it? Oh, this is on the 4-hour time frame, December 23. Where are we? There's our December. Here we go. Yeah, so there was your, in essence, your gap. December, where the hell was it? Oh, it's because it was on the 1-hour time frame. There we are. So this is where we are on December the 18th, 2024, when the rates were cut from 4.75 to 4.5%. We had a gap up. They closed the gap, and then they moved up a little bit, and then there's your FOMC, 7 o'clock. On time, ripped to the downside. God forbid that that is the case, but I'll be straight with you guys. It needs to happen. Come on. How many of you right now are considering buying NVIDIA? How many of you are buying? I mean, Oracle. Oracle is sailing at a very, very interesting spot in the market right now, and investors are all paying attention to this high. Because if Oracle does break it, ladies and gentlemen, Oracle is just going to soar. And it's just had a storming announcement with their relationship going in with OpenAI, a $300 billion investment that's coming into play. So you can appreciate that that company is going to do pretty well in terms of earnings in the near future. That's why everyone's buying up this stock, because of the potential for dividend earnings in the near future, or earnings per share, should I say. So this is something that I'm really worried about, in the sense that NASDAQ could effectively take a nosedive to the downside in tonight's FOMC, but we'll be paying close attention to any subtle clues about what Powell is going to come across as, because he has said that it's either going to be data dependent or we're going to cut, and that's it, because they still have to manage inflation. And the data that's been coming out regarding inflation hasn't been great. Okay. He even said it in the last meeting. We're looking at inflation could be going up to around 3%. That was in the last meeting. And then the inflation data came out 2.9%. So he hasn't been wrong. But when you get data like this on the core retail sales coming in higher, that, in my opinion, is tariff motivated. Okay. And of course, there's been some statistics that have come out saying that the only consumer spending that's coming is from the wealthy. Wealthy people are spending money right now, not the middle class. No one else is spending other than the wealthy. And that is made up of all sorts of things. So information's cooked. In my opinion, it doesn't represent the true aspect of what's going on in the US economy. But Jerome Powell tonight will reveal that for us. Cool. Now, let's just go over into what's going on with Bitcoin. Takes a little bit of a, well, it's taken a little bit of a move to the downside. It's doing all right. But guess what? Bitcoin hasn't gone anywhere. Okay. Going over into Solana, it's doing very well. I mean, cryptocurrency is doing fantastic at these ranges. And for me, the ideal scenario would be rise, retrace, continuation to the upside. I mean, Solana's getting a lot of activity right now, especially with the news regarding pump fund and what have you. But we have had some interesting cryptocurrency news coming into play, which you may or may not know, which I'll be talking about once we get the minutes released in the next 10 minutes. So just quickly going over into it right now, we've got the federal funds rate, which will be out in the next 10 minutes. And then we're going to have the economic projections and the statement. And what's going to happen in the next 10 minutes is we're going to get a news wire coming through that's going to be telling us exactly what we need to know about the actual press, about the funds, the economic projections and the statement. That should, in principle, bring a little bit of volatility to the marketplace, to be honest with you, ladies and gentlemen. Okay, quickly going over to the euro. Euro is currently sat at significant highs, which is very important for us right now, because this is going to be the deciding factor. And of course, earlier on today, I spoke about the idea that we've got a little bit of a problem with regards to the European bonds, how they are being changed. Okay. So it's defined benefit and defined cooperation. I always get it wrong. Defined benefit and defined contribution. Okay. So the difference between the two means defined benefit is someone else is taking on the risk. You don't need to put up the assets to back what you're purchasing. Well, now that's changing. That means now you have to put up the assets that you are purchasing. You've got to have the liquidity behind you to back it. Okay. that's going to effectively remove $2 trillion from the European bonds market, because that's not going to be nice. But where's that money going to go? It's going to go over to somewhere else that they can afford to buy, such as assets in the equity market, stocks, shares, Bitcoin. Hopefully that is the case. Now, going into it, Euro. It is doing a very good job. And the problem I've got is when Euro is so high before FOMC, it just tells me that from the idea of perceived value, because Forex is about perceived value, okay? If you're a hedge fund manager and you've got $100 billion, you're going to look at the European chart and you're going to say, look at euro dollar and say to yourself, well, how many dollars can I buy off the back of this euro? You're going to assume you're going to get a lot of dollars off the back of that because it's got purchasing power right now, okay? Going over into the dollar itself, you can see that it's taken a bit of a tumble to the downside. So I know now that in the next 10 minutes, if the data comes out and it favors the dollar, there's going to be a lot of participants exchanging euros over to dollars. Dollar will shoot up and the purchasing power will start to climb. It won't go above 100. I mean, imagine if it does, but that will only be based on whether Powell turns around and says, you know what? Forget your rate cuts. You're getting one measly 25 basis point cut. Donald Trump can be quiet. We're going to do things our way because the Federal Reserve is independent to the US government. Whatever Trump says, doesn't matter. He tried to get rid of Lisa Cook, never worked. Tried to get rid of Powell, never worked. So even though he's got a few people that are crypto friendly in the Federal Reserve, it's fundamentally the Federal Reserve is its own entity. So no one can do anything. Okay. Now, that story of dollar. Something to pay attention to tonight, ladies and gentlemen. Bank of Japan. They are expected to keep the interest rate as it is, but we are looking to see if they are going to give us the rate hike in the near future. The October meeting is what they are anticipating, which is going to be the next FOMC meeting, ladies and gentlemen, which is October the 29th. So if Japan tonight, because after the FOMC tonight, they will be doing the Bank of Japan press conference. Thursday night, not tonight, Thursday. All right. Let's get that right. Thursday, late hour Thursday. So early hours Friday. That's bizarre. They usually do it on the Thursday. So pound has stepped in. Okay. So if the yen keeps on going up, that's good news for us because it means that investors are trying to park their money into safe havens, but it also means that they're not going to increase the interest rate on the yen. It needs to keep on going up. But the problem is when they do increase the interest rate, the yen still goes up. Okay, so that's a little bit of a problem. But primarily what you want to see happening is you want to see the stock market going up, the euro and the yen going up, gold going up, all against the US dollar. Because what they're doing is they're actually using euros to purchase stock. They're using yen to purchase stock, okay? But what they're doing first is they are effectively converting their euros and yen, they're chucking it into dollar. And without confusing you all, okay, it is sort of the carry trade and it's not. Because the problem we've had is against dollar's purchasing power, everyone's been using euros, everyone's been using yen, everyone's been using Aussie, okay? So you can appreciate that when the stock market goes up, the purchasing power of the dollar is going down and down and down because of the macroeconomic factors that are affecting the dollar. But it's helping other nations like the euro, like the yen, like the Australians, Canadians. It's all helping everyone else because the dollar's purchasing power is lower and it serves other nations, doesn't help the US, but you can see clear as day that the stock market doesn't care. That's why it's still picking up because people are buying hype. That's what they're doing right now, okay? Cool. Now, with that being said, we're quickly going into, all right, we've got 5 more minutes until that action comes into play. Just quickly go back into Bitcoin. Just want to dive into a little bit of order flow on Bitcoin and then understand where we are. Here we go. What's that? No, it hasn't come yet. No. That was something else. Anyways, so right now you can see the book is very light on Bitcoin. It is very light. There's nothing much is happening. What's the biggest order there? 1.9 million. Oh, what the hell? There is absolutely not. 35 million at 114,472. Listen, how many of you right now are currently in leveraged positions? Trades. Now, I'm not talking ones that you've done from a long time ago. I'm talking about ones that you've just said, you know what, forget it, man. I'm going to get some of this flavor on the FOMC. I want that volatility. How many of you just recently opened positions on cryptocurrency in favor of this FOMC? Type 1 if you have, type 2 if you haven't. Okay, I really want to know that. So This is the order flow right now for Bitcoin. Quickly going over into it. I've got literally 3-4 minutes to do this. This is the order flow for Ethereum because it's actually gone to bed. It hasn't done anything, but there's been a lot of accumulation with Ethereum. And usually on the order flow of Ethereum, you do see just clear as day offers and bids, but the offers are starting to disappear. I've not seen gaps in Ethereum for a long time. Okay, Platinum members will know every time I share this chart, it's always filled with offers and bids. Okay, but we're seeing gaps inside of it, which tells me that liquidity is very, very light. Now, someone shared this with me earlier on. Where is it? There's this trader right now on CoinGlass. Okay, this trader is in a very interesting position. He's not put that much exposure down, but right now he's short on Bitcoin, short on Ethereum, short on Pepe and WIF. Okay. And he's in decent profit right now. He's in like 200K's profit. His liquidation price is 123,000. But this is really interesting going into FOMC that he's running currently shorts on this. But this guy, like the value of the order is around 69 million. Okay, it's not a market moving amount. Okay, but it just goes to show conviction on relatively decent, decent capital amounts, right? That where people's expectation is of Bitcoin, all right? So people are running short. So hopefully this person does take some money off the table, with a funding fee of around $7,000. Happy days with $227,000 in profit. Currently in profit for Ethereum at 36,000 there. So it's really interesting to see what's going to happen with this actual trade. Because if this guy doesn't close off profit as we head towards the FOMC right now, then this guy is really going to be deserving of a slap across the face. Take something off the table just in case something wild happens on the announcement. Here we go. So what we got? All right, ladies and gentlemen, we got 2 minutes into it. I'm going to go into the smaller time frames, 15-minute time frame to understand where we are. I'm going to split the chart up. We've got the dollar dominance to the right, and we're going to just pull up NASDAQ for a second because I just want to see how NASDAQ is going to react to it. I also want to pay attention to the bonds market, but I'm not too keen on looking at that right now because it doesn't really move too much, but the liquidity that is required to move the bonds market is absolutely divine. Wonderful. Anyways, so here we go. You look great with the new hairstyle. Thank you very much. Type 1 if you like the bold. Be bold, ladies and gentlemen. I'm pumped for this live. I'm rolling up the sleeves, man. This is where it's at. Okay, here we go. I'm waiting for the information. We have got literally, all right, 50 seconds, gang. 50 seconds. Here we go. We've got some flavor. NASDAQ trying to make a little bit of move. It's already swept last week's high, which is important. Volume has depleted across the board. But yesterday's low could be a point of interest if we do get a stop run right now and the daily open claim, which they have already rejected. Bitcoin trying to get back up above 116,000. Holding out. Remember, the book is light, but the big beef of information is not out yet. This is the FOMC projections, and this is the statement and your rate cut. 4.25%. Let's see what actually happens in the next 15 seconds. Here we go. Here we go. Please. I'm waiting to see what's going to happen. Here we go. Statements out. Projections are out. Now we're waiting for the market to price that in. Here we go. So NASDAQ's going up. Taking yesterday's low. Awesome. Fed cut has happened, in essence. Come on. Right. We're starting to get some data. Come on. My days. Bitcoin. That dude better close that short if it's going to keep on pumping. Come on. What are you doing? Give me some data. Give me some data. All right, here we go. So they're saying the Fed has some luxury in spending, in spreading out cuts. Okay, that's fine. Yeah, we're cool with that. NASDAQ just tapped that yesterday's low and just swept away from it. Bitcoin holding out very, very well. That's good news right there. Oh my days, what is going on here? Bitcoin's coming down. Here we go. We've got something. Come on, let me just have a look at these. Why is that not working? NASDAQ, nothing's happening. Like I said, the projections ain't really what they're too concerned about. They want to hear it from the horse's mouth. That's what they want to do. They want to hear it from the horse's mouth. Let's just quickly go over here. Just have a look at news, what they're saying. Here we go. Fed median projection shows 50 basis more rate cuts in 2025. 50 basis point cut in 2025. So we are going to get more cuts. The median projection shows that. Mystery trader makes record bet on 50 basis point rate cut tomorrow. Have we actually had the cut? Hold on. Has the cut come in? No, but we're getting the cuts. We're getting the cut. Nothing else. Next 2 years, the actual rate cut forecast, the Fed median rate forecast is the actual 3.125%. The forecast was 3.125%, previous 3.375%. Okay, so that's okay. So interest rates have only been cut by 25 basis points. That's fine. I'm not getting any more information just yet. The projection shows 50 basis points more rate cuts in 2025. That is wild. Let's just quickly go and have a look at the bets. All right, so we've just done this one right now. This one has been done and dusted. We've got the cut itself. All right. Holy shoot. Okay, then cool. Let's have a look at October. 72% at 3.754%. People are still betting on 4 to 4.25%. There is a possibility that they could increase the interest rates. If the data that comes out for inflation this time around or next month, okay, if it comes in higher, we've got ourselves a little bit of a problem. October bets, 68.1, 3.5, 3.75. That's okay. But we've still got these commitments here, and it needs to be more over here than it does over at the 375, the 4 spot. NASDAQ, come on. Okay, so you've got realistically no reaction in the marketplace. Nothing itself. Okay, then. So with that being said, right, we've had the statement come out. Let's just quickly go and have a look at what else they're saying over here. So the summary of the economic projections. Okay, here we go. All right, yeah, we've just read that. Okay, no one's really saying anything. Okay, dot plot forecasting 2 more rate cuts this year. Let's just quickly have a look and see if the dot plot chart itself is actually looking at that. 2 rate cuts. Remember, they've already priced that in, ladies and gentlemen. We've already priced in the rate cuts this year. Just had an additional amount to it. Here we go. See, that's good there. That little dot right there. That's good because that wasn't there. Here we go. Governor Miranda dissents in favor of 0.5 point cut. U.S. interest rate decision 4.25. Yeah. So, yeah. Okay. That's good news. Hold on a second. Right. There it is right there. That's the updated one right there. Okay. So longer run is the longer run is something that you don't really need to pay too much of attention to because it's in the longer run. But the immediate range that we need to be looking at, you've got someone down here that's wanting that 2.75% region, and everyone seems to be good on the idea of around 3.5%. Now, this is where it gets interesting, okay? When you have got the idea that the majority of participants in the Federal Reserve believe that the sound interest rate's going to be around 3.75%, hedge fund managers, money managers are going to look at that and then project out what their behavior is going to be. So that's either going to be a continuation in appreciation on the euro and the yen, or it's going to be a continued depreciation in the dollar. So that's going to then determine where they're going to maneuver the assets. What are they going to go into? They're going to go into defense-based stocks. What's going on? But remember, we're going into an easing cycle. But all the money's been borrowed, man. We're at highs across the board. So in order to really get the utility of being able to borrow cheap, you need to smack everything to the downside, reset the whole thing, and then continue about your business, okay? So that's where we are. NASDAQ still not taking it. Fed policymakers see 4.5% unemployment rate at the end of 2025 versus 4.5% in June projections. Okay, so we're not really getting anything great right now other than the dot plot chart itself, which was brilliant. That is good news that we've got an alignment with all the board members wanting to say, yeah, okay, lower rate cuts because they have been in the dark about it. They've been up in the air. So that is good news for us. The VIX is dropping. Yeah, the volatility index is dropping because they are actively hedging themselves. No, coming out of exposure into hedges. Okay, so where are we with the VIX? NASDAQ, don't even try it. Don't even try it, NASDAQ. All right, is this the fake pump? Is this the fake pump? Maybe this guy in his short. Let's have a look. Where's his short? Hold on. Where are you? You still in your short, my friend? Yeah, he's still in his short. He's watching this chart. He is watching this chart. Volatility index takes a little bit of a gap down. That's a problem for me because it does usually fill those gaps. So that might be something we need to pay attention to. The SPX, yep, clearing, nearly getting to its all-time highs. NASDAQ not quite taking it. The S&P itself, where's S&P? Well, let's just look at the index of the S&P and the NASDAQ. So you can see both are at significant levels. Not quite taking their all-time highs just yet, but ES1, nah, not quite there yet. Let's just go and have a look at some stocks just for a second, just to put it into perspective. NVIDIA, where you at? My days. This is meant to be a tech stock that is killing it right now, and it's not. Any more news? Here we go. Fed policymakers see 1.6% GDP growth in 2025 versus 1.4 in June. See longer run growth at 1.8% versus 1.8 in June. What? More GDP? But you know what that means? It means that the US is still spending money and it still is going to have to spend more but earn less. Oh, God, this is getting absolutely wild. Okay, check out gold, mate. Okay, let's have a look at gold. Let's just look at where we are with gold. Gold's really doing the flavor right now. It's done a stop run lower, and it's now making a nice continued move to the upside, usually because that's what happens with the anticipation of rate cuts. However, it's a little bit stalled. Powell has got to come out and say you're going to get your rate cuts at this point in time. That will fuel gold's price to the upside. That stop run lower to see the move to the upside is something that we've got to pay attention to. All right, Bitcoin doesn't seem like it's doing too much, ladies and gentlemen. Oh, gold is moving. Here we go. Gold is starting to make a little bit of movement. There is a lot of things happening right now in cryptocurrency, ladies and gentlemen. I just want to draw your attention to it, okay? You've got here that Trump could declare a housing emergency in 2025. Polymarket bettors are giving it at a 34% chance as mortgage distress mounts. That's no good, okay? It says here, but I said this yesterday. Searches for help with mortgage surpassed 2008 housing crisis. But people are talking about it in the wrong context. What if it's help just to raise money to actually get a mortgage? What if we actually are seeing growth in the housing market? Because the interest rates are coming down. So naturally, it should be easier for people to consume credit to go and get a mortgage. Remember, we're not in a problem with credit yet. Credit is not a problem just yet. It's not going into chaotic areas. There's no stresses right now in terms of credit. Banks are all good. Okay, hold on. Downside risks to employment have risen. That solidifies more chances of rate cuts. Traders add to bets on at least one more Fed rate cut this year. So that's where you get the 50 basis points cut. 25 now, 25 later on. Okay. Bitcoin's doing okay. Gold is at all-time highs, ladies and gentlemen. It's going. That's what happens when you get a rate cut because gold is inverse to the interest rate, so the yield on the dollar is going lower. Let's just quickly go and have a look at the bond market for a second. 10-year bond, there you go. She's moving up nicely. 2-year yield taking a slump. And then, of course, the 5 years going down. The 10-year is going down. That's good news right there. 10 years just broken 3.9%, ladies and gentlemen. 3.99. That is really good for the marketplace. 30-year yield spiked to 4.6, come back down to 4.61. But the 10 years not really doing that much. Then again, you do need a lot of liquidity to move it. The ultra bond market's doing okay. 10-year futures are doing well, so there's expectations of the bonds coming back up. Quickly going over into dollar itself. Dollar's gap down, which is a problem for me, a bit of an exhaustive gap, if I'm quite frank with you. But gold is naturally going to keep on going up, and you can get the dollar going up as well as gold. Hold on, I've got some more news coming in. Here we go. Fed projections show one policymaker estimated the appropriate policy rate for the year end at 4.25, 4.5%. One saw it at 2.75 and 3%. He's having a bubble. The guy that saw that, and I'm guessing that's this dude over here. This is the anomaly in the actual Federal Reserve. I like him. He's cool. He seems like he's the guy that turns up with a beer in his hand for the FOMC meeting. He's like, well, what's good, ladies and gentlemen? He's that party dude, okay? That has to be someone who is either from Trump's administration, because, boy, that is a big jump, and the clear differentiation between what they all believe against what one guy believes. And that's what this dot plot does. But he's kind of all right with it in 2026. Okay, so you can see that story there. There is agreement down there. But right now, they are all expecting that's the interest rates. Oh, I thought that was Bitcoin for a second. I got a little bit excitable. Right, Bitcoin's not really doing anything. It probably won't do anything until the actual press conference itself, ladies and gentlemen. So quickly, some news in cryptocurrency for you guys. Solana and XRP. Sorry, Solana. CME Group plans to launch options on Solana. Good news for Solana, right? Great news for Solana and futures for Solana. Okay, just how do we get rid of that? Just if I go to the code, I just don't really want to focus on that. So yeah, the CME Group plans to launch options on Solana on the 13th of October, pending regulatory review. So that's brilliant for anyone that's in Solana positions. I mean, it is good news for XRP. Let's be honest now. I know I'm giving you a little bit of but it's all good for XRP, man. Yeah, that is good news. But let's get into other matters. Here we go. Why are a myriad of users betting on the color of Fed Chair Powell's tie today? So they're expecting that if he says good afternoon, the markets are going to sink. How many of you are right? You know what? Let's do it right now. Let's do it right now. Start a poll. Good afternoon, okay? Is it going to lead to a pump or a dump? Here we go. Pump. I want you to fill this in. Pump, dump. All right? Now, here's the question. Please, right? Don't let the poll have more votes than likes on the live stream. Please don't do that. Please don't do that. Because that's just sad, right? When you answer the poll, like the stream, ladies and gentlemen, it helps with the good old algorithmic mixture. All right? Cool. So they're all expecting that his tie is going to be a signal. I mean, it's a joke. Okay? Let's be honest now. But purple has become Powell's signature color, signaling the Fed's commitment to neutrality over partisan red and versus blue politics. I mean, come on. Hold on. We got some news. US futures price in about 69 basis point cuts in 2025 after Fed statement. Little changed from before, okay? Futures price in 94% chance of Fed cut in October after the Fed statement. It was 71.6. Hold on, so they've just adjusted that. Let's just quickly go back into the chart. Are we going to see that? Where are we? There you go, ladies and gentlemen. Right there. That was December. There you go, 3.75. Look at this. What did we just say about this a few moments ago? Okay. 3.75%, 4%, 94.4% are the traders' bets in October. Okay. Then December, we're going in for 3.5, 3.75%. No one's interested in 4 to 4.25%. So the market is anticipating that we are going to get the rate cuts. Now we're going to see the truth of it, because the rate cuts don't automatically mean that everything changes straight away. The way business is being run is now going to be done differently. Yields have taken a nosedive. Corporate finance is now being refinanced at lower rates. And I think that's why they're trying to do it at speed. So we're now getting the bigger cut. So what is it going to represent? Is it representing stress in the economy? Because when Japan wake up tonight and they realize that the yields on the dollar are actually going to the downside, they're going to be asking themselves, well, why are you cutting so aggressively? After having it up for so long, your inflation problem is still there. What are you doing? Now, who's this? What's this guy done? Oh, the short. Bitcoin. No. Bitcoin. Position. There you go. 700,000. About to clear 1 million if Bitcoin continues this move to the downside. He's going to clear 1 million. Here we go. He's just about to clear 1 million. Come on. Do something about it, bro. Take something off the table. He's already at $1 million in profit across the bottom. Why is he in that Bepe short? $549. Why would you do that? What are you proving there? All right, so Bitcoin's taking a bit of a tumble, ladies and gentlemen. What's going on there? Have a look at the NASDAQ for a second. Oh, don't repeat history, man. Don't, please. Don't do it. Tales from the crypto, thank you. Who's doing these? Who's doing these memberships? Mad love, man. Oh, Viking Impulse. Thank you very much for that, man. Giving love to everybody in the Discord and, of course, the pattern watchers. And if you are new, ladies and gentlemen, and you haven't touched down on the Traders Reality website, I strongly recommend you do it. There's a wealth of information that's going to help you understand how to use this indicator we've got here, the system. It's the hybrid system, but there's a PDF on there to help you get started. Get part of the Discord, and the indicators video is right there. It shows you how to do it. Then, of course, if you want to become a platinum member, gold member, or become a member overall, get to the member section, join where you get trade setups every single day. We haven't done any today because I don't really want to encourage anyone trading this wild price action. But every single day we do projections on Bitcoin, Ethereum, Solana, Euro, gold, and NASDAQ. Okay, so if you want to check that out, everything is on the Traders Reality website. It's pinned to the top of the chat. Okay, cool. Now, quickly, NASDAQ, what we got? Actually, let's have a look at what's going on with other players across the board. Check this out. Here we go. Let's just have a look at Circle. Need to look at Circle. I'm buying, guys. I am going to be buying Circle, okay? I've got a couple of stocks that I'm paying attention to. I want to pay attention to Circle. I've got to look at Bullish. Here's Bullish, okay? Bullish is doing all right. I like Bullish because the volume's present, okay? Average daily volume is there, okay? And Gemini. Where's Gemini? Now, Gemini's got a little bit of a problem, okay? Because of the story behind the SEC, the investigation that they've got with the SEC, it's going to determine whether or not these guys are going to just see us. Oh, obviously, it's not been liked. All right, listen, Gemini is coming in down, right? That is sort of okay, but that must mean it has something to do with the quarterly announcements are terrible. Sales and earnings were just shocking. I might be skipping on Gemini. Just want to see if it's actually going to do anything. I mean, 24, it's just taken too much of a nosedive for me to really consider it now. But Bullish and Circle seem like the ones that I'm interested in. And I'll tell you something else. I'm actually looking into investing in robotic stocks, humanoid robotics, because that's where NVIDIA wants to go. Now, they're saying that in the next, by 2035, we're looking at maybe $150 to $200 billion market cap. That for me is a little bit poor for the robotic market. But with quantum computing coming into play as well, might be bouncing between the two, but I'll be talking to you guys about that another time. But those of you that want to try and buy Circle and Bullish, depending on where you want to buy it, you can go and buy it via BTCC because they do actually have the ability to buy it. So where is it on here? Here you go, Bullish. You can buy Bullish right there. And then you got Circle as well. You can buy that. So if you haven't used BTCC before, you can trade crypto, Forex, and all of that stuff. That's in the description of the live stream as well. So check that out if you want to join BTCC. You don't need KYC or VPN for this exchange. All right, cool. Now, where we at? 10 more minutes until the flavor comes in. NASDAQ's taken a little bit of a tumble. Any more news? Oh, they're changing it now. Here we go. Fed projections imply additional 50 basis point rate cuts in 2025, 25 basis points more in 2026, and 25 in 2017. So in total, we're getting 100 points. So hold on. No, 75 basis points is the right. This is important. Investors want to know the path. Because if they're going to go on the path, because if you go back and look at this, the longer run says 2.25% is where Fed members believe things are going to be, okay? What we're doing now for anybody that's passing through is just putting logic to the macros, right? I'm just reading, just not telling you what this chart is in per se. I'm trying to put logic to help you understand what this information means, okay? It says here that projections imply additional 50 basis point rate cut in 2025. That means as well, 25 basis point cut in 2026 and 25 basis point cut in 2027. So what the question is, if you remember back in December, before they did the rate cuts, okay, what was the end path? What was the path of resistance per se? When will the cap come into play? That means when will they stop increasing the interest rates? When will they stop the tightening? Okay. Now we've got the start of the easing, but now we want to know when that will end and how long for. And according to this, it's saying that 50 basis point rate cut in 2025. We've just had 25 now. So that means we're going to get another 25 in October or December, right? Then it says 25 basis point cut in 2026. All of 2026, we're only going to get a 25 basis point cut. And then all of more in 2027, 25 basis points in 2027. So in essence, we're getting 100 basis points, okay, over a period of 2 years nearly, right? Is that good? But they're still borrowing more and deficits are going higher and higher. So the rates technically are still going to be high. 3.754%. I mean, 3.25, 3.5, 3.75. I mean, come on. Ain't that a little bit steep? We'll have to wait and see. NASDAQ pulling back. Bitcoin, where you at? Oh. Has he done it yet? Yeah, he's still in the position. Still in the position. Lost a little bit. He's minus on the Pepe one. $210. What a guy. Close it, man. You're losing money there, but you got nearly $500,000 plus in your Bitcoin trade. Do something about it, man. All right, then, cool. We're going to be getting ourselves ready for this FOMC, ladies and gentlemen. Here we go. So, do we have any questions, ladies and gentlemen? Let me look at this poll. Hold on a second. So I'm looking at the poll right now. Look at you all, man. 1,392 votes. 1,094 likes. Ladies and gentlemen, don't do that. Please don't do that. I've got a goal for 3,000 likes in this live stream. If we can achieve that, ladies and gentlemen, that will be happy days. I would strongly, really appreciate 3,000 likes. It's free to do, man. Just hit the like button. I'm joking. No, don't. I'm not joking, but you know what I'm saying anyways. It's all fun in games. Cool. All right, and you haven't heard from Steve in a while. Well, Steve doesn't call anymore. He doesn't. Why would I call myself? Never mind. We'll talk about that another time. Here we go. Let's have a look at where we are. Solana. Look, this compression of price is great news for cryptocurrency. It really is. Why is XRP doing that? Never mind. We got any purchases happening on the ETF? Let's just quickly break that down because we're going to get the FOMC started very, very shortly, ladies and gentlemen. I just want to see if we've had any activity coming into play. All right, 763,000 was the last reading. Yeah, nothing really happening there. Let's just quickly go and have a look at some open interest right now. Let's have a look at where we are with Bitcoin. Yeah, seems to be pulling back for that. I mean, that point is really what I want to see Bitcoin doing, 120,000 on the Bitcoin. Just have a look at where we are with open positions right now. Let's see this. So we've had some, this is liquidations delta right here. And we've seen quite a few short sellers coming into play. All right, not many longs. Yeah, but that made sense. That made sense because the order book's not really doing too much. Ethereum's come down to this point to spike back up again. It's collected those bids. Got quite a decent bid size down here. Where was it? Yeah, 8 million. There you go. It's actually taken it. I've added another 5 million. Oh, that 8 million wasn't taken. There we go. Only 2.53 million has been traded. So 40% of it has been attacked. Nothing great on that. Let's quickly go to Bitcoin, see where the order flow is there. Wiki price action. I mean, you don't trade this BS. Here we go. So nothing really great right now. 6 million, 5 million on the order book. No real commitment coming in. 5.7 million transacted on Bitcoin at the lows at 115,380. Here we go. 4 minutes, 6 minutes, ladies and gents, to get into this flavor. And I'm going to get myself ready for the live. Come on, Bitcoin, man. Are you going to do it? Are you going to do it? Tino, got anything open? No. You know what? The amount of times I've traded whilst being on a live show, I can't do it, man. I can't look and trade, unless it's in a cryptocurrency position where I'm looking at Bitcoin. But because I trade a lot of NASDAQ and S&P and I'm jumping between positions, I've got to pay attention to the depth. I can't do it. I don't, like in my household, you try and speak to me when I'm trading. Don't. It's not going to work. You could be pouring with blood and I'll be like, just hold that for a second. Let me just see what the depth's doing. And you're pouring with blood right now. I'll just be like, just wait a minute. That's just the commitment right there. It's mad. Okay. My thoughts on my trades. Feels great to not have a position. It does. You know what? It's good to not have a position because you're up against this BS right here, this wild behavior right here. Okay. Cool. Ladies and gentlemen, I think it's now time to get this party started off. Right, I'm going to get myself ready. Go and get yourself some coffee. No, actually, don't go and get yourself your coffee because you're going to leave the live. You don't want to do that. Here comes the crash. No, there won't be a crash. Speaking of which, market expert says XRP price at $1,000 will happen, but the timeline, I don't care. No, it can't be $1,000. $1,000, bro. That would just, you know, when XRP hits $1,000, I mean, bro, that would just be That's not even wife-changing money, you know. It's not wife-changing money. It's, I'll become AI. I will pay for chips to be installed in my brain, and I will know Kung Fu, Neo style, baby. That's exactly the first thing I would do. I'd go to Elon and say, give me that chip, man, and upgrade it. And that's what I'd do with that. Anyway, Eric says that the Fed cut is going to send crypto-tied stocks surging in Q4. This is important, ladies and gentlemen, because we are already looking at crypto-based stocks. And Coinbase CEO Brian has turned around and said, okay, that this Google stablecoin thing is great news. Okay, so my loyalties are to Circle. Why? Because Circle is the pioneer, in my opinion. All right. It's come to the stock market as a stablecoin issuer. So everyone's going to go to Circle, right? They're already making the USDC native coin on a Hyperliquid. So they're already planting the seeds. But with Circle, it's about merger and acquisitions. That's why I'm investing in Circle. All right. They're going to start buying up all the other stablecoin providers and all have them in one place. Fits with the title of their name, Circle. It's all one conglomerate of stablecoins, and you control it all. That's my opinion. No, they're not making me think that. No, we're going to get rid of that. We're getting rid of that. I'm not interested in that. Look, this is good news. Solana and XRP. And I believe Solana is going to clear out a very significant range. It's going to clear out its all-time high. Okay, that's what I'm expecting for Solana. It's done very well, and this consolidation here is actually wonderful. Right, we've got the FOMC set up, ladies and gentlemen. Let's just get into the flavor. I'm going to get my charts all set up for you, understand where we are with everything, and then happy days right there. So here we go. Right, I'm not really seeing. Here we go. So I'm going to click this. All right, then. Let's get this party started, gang. Look what I've done. Well, Tino. He's made it nice. All right, and so let me just get this here. Click that bad boy. Move that into position. This is Bitcoin, and this is Powell. I'm going to move this ever so slightly. There we go. That's what we want to see. Move that a little bit. You can see the chart right there, can't you, ladies and gentlemen? Okay. Here is the moment of truth. Here is the moment of truth. Oh, my God. This FOMC is going to be actually wild. Tina, if you are forced to take a haircut, will it hit bone? What kind of question is that, man? Never mind. Well, man, it's just, I've just clipped my head, man. That's it. You need more likes. Yes, we do. How many likes can we get, man, before this live stream? Here we go. It's going to start. It's going to start. Let's get this party going. Come on. Come on. Come on, Powell. Oh, my God. This is getting very painstaking. Here we go. Let the games begin, ladies and gentlemen. Whoa. What's going on here? Whoa. What's that doing? What the hell? Oh, don't do that to me. No. Come on. It's crashed. No, it hasn't. FOMC YouTube. It's not working. Hold on a sec. Let me bring it up here. Let me bring it up here. I don't believe this has happened. Look at that. Someone said it earlier on today to me as well. All right, let's go. Come on, pal. Come on, pal. Here we go.
It has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point.
Here we go.
We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments.
Let's see what he has to say.
Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June.
See, we already know this information from the projection
In the
statement.
labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027.
You can't get to inflation to 2% yet.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
Not third mandate.
At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed.
More data in
Our
the future.
obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
NASDAQ don't like it. Here we go. This is the beef of it all, ladies and gentlemen. This is where it gets interesting.
Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Myron has continued, kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
You good old pal. Never sharing anything.
You and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Bitcoin taking a little bit of a move. Who's next?
Nick Timmeros of the Wall Street Journal.
I like this guy.
Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
What a guy.
I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done...
That's not good.
We've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly
NASDAQ
to
didn't
a
like
new
that.
place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place?
Market
I guess
doesn't
I'm
like
just,
it.
Trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
50
Yeah,
basis
I think
point
you
not
could think of
accepted
this
across
in a
the
way
board,
as a risk
right?
management cut, because
That's hurt the
if you look
market.
at the SEP, actually
Yields are
the projections
flying.
for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
So just looking at the SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We
tell us what
fully
we need to
understand
know.
and appreciate that we need to remain fully committed to restoring 2% inflation
He's buckling.
on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think.
What is wrong with this
And in terms
guy?
of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
They're not liking these questions. He's out there. He doesn't like it.
Michael McKee from Bloomberg Radio and
Do it again, come on.
Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see
hear
that,
that?
as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
If I could follow up, every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year,
2027,
this
okay.
SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in
Perfect
telling
question.
people that that's what you're going to do if you can never reach it?
Well, I mean, you're right.
Perfect.
It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's, that's literally how you put the projections together. You're writing down a rate path, which is designed
He's
to
boiling.
create
Look at him.
over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
The Fed is the advert to the world. Come and buy my bonds.
Thanks so much.
He's not doing a good job of that.
ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
Who's that guy behind him, man?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods.
Why is it kicking up like that? Can't be because
Prices
of
from
that. There you
tariffs,
go.
but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do. But we have two mandates, and we try to balance them.
Three.
For a long time, our framework says that when our two goals are in tension, and this is quite an unusual situation, how do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal, and how long is it expected to get to the goal? So, and then we think about those things, and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Bitcoin's picking up steam.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the
That's
meetings
not
to
my
come? Thank you.
computer.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of this, of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But
don't
you're right.
care what you do at your tea
It's a
parties,
wide
bro.
dispersion
Come on.
of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years.
He won't answer it.
But as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political
Surely he's not going to
considerations?
answer this question.
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just, everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now. And people they're making their arguments, and we're having a great discussion around these challenging issues. So,
Do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Of course you would, pal. Starting to not like this guy anymore.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be?
He won't admit that.
Earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. And we took that appropriate action.
He wouldn't admit that question. That makes the Fed look stupid.
Thanks, Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a 1/4 percentage point now is going to arrest that?
Well, I didn't say that I thought a 1/4 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin.
NASDAQ's coming straight back up.
The labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, That's how we see it.
That's how we see it. He's not finishing
Hi,
strong on
Stephanie
these
Ruhle,
questions.
MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says.
They're taking the piss out of the Fed.
So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Bank, Federal Reserve System, and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Do you understand they're
Chairman,
slating the
Neil
credibility of the
Axios.
Fed right now?
There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down.
Didn't pay himself.
And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
He didn't pay himself, that trader. What a guy. He still got it open. That was at
Thanks, Mr.
800,000.
Chairman.
Now it's
What
174.
What evidence do you see of tariffs showing up in inflation?
Great question.
Well, if you can take goods, just sort of the broad goods category. And last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
What the hell? Why did he say it like that?
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say?
It must be when I change over.
To markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work
he's
is
taking
to
positions off.
Make really strong arguments based on the data.
He's
and
taking trades off.
One's
Good
understanding
man.
of the economy. That's really all that matters.
That's good.
And that's how it's going to work. And
he paid himself.
I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Fed versus president, man. This is a real thing. This has been insulting for the Fed.
Given the range
Seriously.
of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and, business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Hi, Nicole Goodkind with Barron's. Thank you for taking my question.
Barron's.
Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. Okay. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply.
It's not an economic lesson,
and so
pal.
some of
Come
that
on.
should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot big changes in rates to matter a lot for the housing sector.
Which
And
you're not
the
giving.
other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And
That's
just
where
a
it
quick
is.
follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
You know, forecasting is very difficult even in placid times. And as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Fair enough. Fair enough.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size
Thank
of
you,
your
Harry.
balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally
This
now.
is
As you know,
important.
with the balance sheet,
Listen to this.
we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. You know, the level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but
Financial
also moderate
stability.
long-term interest rates. So what does Congress
She
mean
mentioned
by
it. Fair
moderate
play.
long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So
You don't like that question?
we always think of it as the dual mandate, maximum employment and price
No, it's the
stability for a long
third.
time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that as
We spoke
for a
about
very
it
long
last
time
night,
as
the third mandate.
a third mandate that
Go
requires
check that out.
independent
Listen to
action.
that.
So that's where that is.
Oh, wow.
And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Shut up, pal. Are you serious? Financial stability is not something that you want to put to work.
We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession. And delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances? And do you expect today's cut will help?
So,
Nah.
we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that. But over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Oh, so dead.
This rate cut is coming at a time when the stock market is at or near all-time highs, and some
Nice one,
valuation
bro.
metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully.
Third mandate.
And I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate, and I know that
Kevin, we
people at the
got the
lower
cut.
end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture we don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Last question, ladies and gentlemen, the last
Hi,
question.
Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates.
It decides whether they should buy
Thanks
your
very
bonds or not. Yeah, thanks very much, pal. You can go and kiss the... you know what, ladies and gentlemen? That is just absolutely dog. Honestly, that was absolutely dog. All right, he diverted so many questions. Right, so we got our rate cuts. Okay, cool. But he did say that there were more participants that didn't want the rate cut. Okay, so in essence, he's given us what the market wanted, and he also dismissed the idea that just because the market has priced in the logic of several rate cuts doesn't mean that we're going to get them. It's going to be data dependent. So what kind of joke is that? You know what, ladies and gentlemen, just quickly having a look at where we are across the board. The euro sweep to the upside, yearly highs, 0.119. What a joke that has been. Dollar dominance came up, and then it's just rejected that point as well. The NASDAQ made a nice move up. It's only come down. It's moved lower and cleared the gap. That's good news, to be frank with you. It's cleared the gap, so now we're at a neutral level. I'm glad that they didn't actually roll everything over, but the impact of a rate cut has now come into play. They're now going to price in the future of what it looks like. So we're going to get another cut in October. So the market's going to move itself in that direction. Then we're going to look for another rate cut in 2026, then 2027. So, quite frankly, ladies and gentlemen, there's a little bit more to it. We need to wait and see what the dust is saying because, look, futures markets have come down on the bonds. The yields have shot straight back up again. Investors have taken out bonds. They've now gone into demanding more rate of return for the bonds itself. So this will really grant an idea of what to expect next when it comes to the marketplace. And that's something that I'm going to be discussing in tomorrow's live stream, ladies and gentlemen. So with that being said, mad love to all the members that have just joined in the YouTube channel. Mad love and respect for that. Sack Trades, I see you. All right, B Stu, what is good? But other than that, guys, again, head over to the Traders Reality website. Go check that out. It's pinned to the top of the chat. Get involved if you are new. Like the live, like the stream, subscribe, and I'll be tuning into you all tomorrow, ladies and gentlemen. It has been an absolute interesting live. You know what I really want to say. But anyways, take care of yourselves, gang. Mad